Today, we're looking at an analysis report on Beyond Meat, BYND, which is trading around $1.22.
Right, the classic high-risk, high-reward setup.
Exactly. It juxtaposes these really severe financial pressures against the potential for a massive short squeeze.
And the report does a good job of that.
It does. It's very clear in separating the Wall Street bear case, the huge operating loss, the billion-dollar debt, from the more generalized retail bull case. That clarity is a great starting point.
It is. But that foundation immediately brings up a huge question for me. Given how bad the debt situation looks, how does the bull case even, begin to address that existential threat?
That's it. That's the first big area. To elevate this high volatility trade hypothesis, the analysis has to more robustly integrate that catastrophic debt-to-cash ratio right into the retail bull case strategy.
Okay, so let's break that down.
Well, the analysis makes a really strong case for financial distress. It highlights the $1.3 billion in debt against, only $117 million in cash?
Which is a severe liquidity threat, to put it mildly.
Right. But the current bull case, it relies mostly on these general factors, like the market cap being deeply undervalued, or just a general hope for good news.
And that's the weakness. It's a huge structural gap. The bull case just doesn't counteract the main argument for the stock going to zero.
Generic hope isn't a strategy. Not for a sophisticated trader anyway.
Exactly. The short thesis is the liquidity failure. So if there's going to be a short squeeze catalyst, it has to involve a plausible structural liquidity solution.
We need to see that connection.
So the suggestion for improvement is that the analysis should specifically connect the bull case opportunity, that short squeeze potential, to a plausible data-driven mechanism that directly addresses the debt.
Ah, okay. So you're giving the trader something objective to follow, not just market vibes.
Exactly. You legitimize the whole buy the dip idea for someone who's actually technically adept.
But I guess the question is, does tracking these complex institutional signals, does that really align with the high volatility trader this report is for? How do we make that connection truly actionable?
We have to, because that institutional confirmation is the only thing that validates a long thesis against this much fundamental risk.
Okay.
So instead of just mentioning, generic debt restructuring, we need to explore what technical actions or market signals would actually precede that.
So some concrete examples of what to track?
Yeah, absolutely. We could suggest analyzing movement in BND's corporate bond market. That can be a lead indicator for institutional faith.
Interesting.
Or maybe analyzing options activity that might hint at a debt conversion, or even just tracking volume spikes that are, highly correlated to whispers of private financing news.
I see. So these are specific, tangible indicators.
Right. They provide a data-driven reason for a short squeeze beyond just sentiment. It puts the entire trade thesis on much firmer ground.
That's a really powerful distinction, moving from general retail hope to actual technical indicators of institutional confidence. And speaking of technicals, that actually brings me to the next point. We also saw an opportunity to refine how the price points are defined in the report.
Okay.
So while the established technical price points, the 1.21 support and 1.42 resistance, are essential, deepening the volatility analysis requires integrating volume conviction thresholds.
Right. That earlier 36% spike in the stock and all that intraday volatility, that sets the stage perfectly for this kind of trade.
It does.
But the weakness is that these movements are treated as isolated price actions. For a report that's targeting high volatility traders, it needs to establish what level of trading conviction is required to break these levels and actually sustain a move.
Not just identifying the price points themselves.
Exactly.
That makes so much sense. In a situation this extreme with so much short interest, price action alone is unreliable.
It can be a trap.
Yeah, a short covering rally can temporarily inflate any move. We need a quantitative measure of conviction.
So what's the suggestion?
Our suggestion is to integrate the analysis of that 36% spike and the current volume dynamics to establish conviction thresholds. Thresholds that dictate if the trade strategy is even viable.
So you're emphasizing the need for a big influx of volume to actually confirm a break.
Otherwise, $1.42 is just a head fake.
Yes, and if we're tracking institutional confidence through the bond market like we just discussed, we have to confirm institutional action on the charts here.
So how do we make that concrete for the trader reading this?
We reframe the break of $1.42.
Okay.
The analysis should suggest that the move has to be supported by a minimum daily volume target. Let's say X times the average volume of that prior 36% spike.
Right, so that would confirm institutional or at least serious contrarian capital is involved.
And not just transient retail buying. It turns a hopeful technical read into a validated technical entry. It mitigates the risk of a swift reversal.
I like that. And we can apply that same rigor to the downside, to the $1.21 level.
We can. We can link that critical $1.21 low, not just to price, but to a volume decay metric.
Volume decay. So you mean the price is holding a key level, but the trading activity is just
Drying up.
precisely. The report could suggest that if the price holds $1.22 but volume keeps declining, it's a signal that the support is fragile. There's no buyer conviction. It's an early warning system.
Exactly. An early warning built on objective data that comes before a price break.
That level of detail adds some serious actionable value. Okay, let's address something else. Something that often comes with these high-energy trade ideas.
The writing style?
The flair in the writing, yeah. The material is robust on its financial data. I mean, the minus $1.44 EPS, the $110 million net loss, those are stark realities.
They are.
But the language describing the opportunity is, well, it's highly energized.
Right. So to elevate the material from just a market summary to a high-level analytical report, selectively replacing that sensational language with objective financial framing will really increase its authority.
The weakness is pretty clear, right? The report uses these highly charged phrases like retail army, ultimate buy-the-dip opportunity.
And calling the stock a cheap lottery ticket.
Exactly. And those phrases, they capture the market sentiment perfectly, but they clash pretty severely with the analytical seriousness that should go with the deep fundamental data.
That mixed tone, it diminishes the report's credibility, especially for the expert traders it's trying to reach.
So the suggestion is we need to maintain the focus on the high-risk, high-reward nature of the trade.
Of course.
But we have to couch the bull case in terms of, say, structural mispricing and extreme short positioning, not just emotional or meme factors. The language has to match the gravity of the financial risks.
Okay, but is there a risk that by stripping away that fun language, we lose the authenticity that draws in that specific audience, the short-term specialists?
Not if we replace it with language that speaks to their actual strategy and expertise.
Okay, like what?
Well, instead of cheap lottery ticket, we could use language that describes the potential for a highly asymmetrical return profile.
I like that.
It still gets across the idea of huge upside potential, but without sounding, flippant about the $1.3 billion in debt.
You're describing the structure of the trade and not just the sentiment. And we could substitute retail army with something like aggressively contrarian traders.
Or short-term volatility specialists.
Yeah, that shows the report understands who the players are without using social media jargon.
And we want to make sure the final verdict, which correctly identifies those key 1.21 and 1.42 levels, is presented as a battlefield of capital allocation.
Not a simple moon or zero prediction.
Exactly. That linguistic calibration makes the whole thing feel grounded in complex finance, not just market share leading.
Excellent point. Now, let's bring all these threads together. Let's get to the so what for the trader.
Right. We've established that the analysis has separated the fundamental risks from the technical opportunity. It's time to merge them into one cohesive strategy.
The concluding verdict has to synthesize those fundamental financial risks with the technical traders. It needs to provide a fully integrated strategy for the high volatility trader.
And the weakness right now is that the verdict is sort of an either-or statement.
Run away versus buy for a squeeze.
Yeah. It doesn't fully show how the severe fundamentals, like the cash burn from that $110 million net loss, should directly inform the technical trade execution plan.
An expert trader needs a contingent plan. It's never just A or B.
So the suggestion here is to build on that. We have to create a clear, actionable synthesis that models the risk based on the company's financial timeline.
This is how you validate the audience's expertise, by integrating both datasets into a contingent strategy.
You're using the fundamental data to pre-validate or maybe invalidate the technical levels.
Precisely. For example, we could suggest modeling the stop loss based on news related to the cash runway. We know the company only has $117 million in cash.
Okay.
So if management releases an update that signals that cash will be gone sooner than the market expects, maybe because of some unexpected lawsuit or an operational failure, then the technical $1.21 support is instantly invalidated, regardless of where the stock is trading.
You got it. That's highly specific. The analysis should require the stop to be moved proactively based on a fundamental timeline, not just waiting for the stock to breach a line on a chart.
You're using the cash runway as the true stop loss.
That's really smart.
And conversely, if a positive fundamental factor is announced, like a major strategic partner or a confirmed debt refinancing, the analysis should suggest scaling into the position.
So not just one big trade.
No, you scale in on a confirmed, volume-supported break of 142. This manages your leverage against that ongoing high debt risk. It makes the verdict a nuanced execution map, not a simple recommendation.
This has been a fascinating deep dive, a classic high volatility setup focused on BYND.
The ultimate Wall Street versus retail debate.
It is. So to recap the major actionable opportunities for the analysis report. First, integrate that debt crisis directly into the bullish mechanism.
Right, turn liquidity monitoring, like bond or options activity, into the actual catalyst tracker.
Second, use conviction metrics to define the technical triggers. Demand volume analysis to refine those 1.42 and 1.21 levels.
Making sure any move is confirmed by serious capital, not just temporary noise.
Third, adjust the tone. Boost that analytical authority by replacing the highly charged phrases with more sophisticated financial framing, like asymmetrical return profile.
And finally, synthesize fundamental risk with technical execution in the verdict. Create that precise, contingent strategy where the cash runway dictates risk management and fundamental catalysts inform how you scale the trade.
That framework really ensures that the Wall Street data and the retail thesis are working together to inform a truly professional trade plan.
Well said.